Well, I think that the market traded lower initially on Mondays, primarily because you buy on rumor and you sell on the news. And I think that investors probably were thinking, okay, we got the kind of stimulus package that had been anticipated. It will likely be passed in short order. And then we have to wait and see what the next stimulus package will be after the new president is inaugurated. Add to that some concern about the strain coming from Britain, and I think investors are wondering, gee, maybe I should look to take some profits. But it seems as if the new strain is not something that we will have to develop a new vaccine for. It will be handled by the existing vaccines. That's correct. The stimulus plan was first talked about back in September, October, before the election. Not surprisingly, no stimulus package came to fruition because neither side wanted to let the other side claim victory ahead of the election. And now again, because each side has a different agenda, that it was pretty tough to get something through Congress. So I would tend to say that now Wall Street is looking for the next catalyst to push share prices higher, but with a good 80% of the companies above their 50-day moving average within the S&P and more than 90% above their 200-day moving average. I think a lot of people have already bought into the stock market and is probably due for some sort of digestion of recent gains. Stimulus will probably have to wait until after the inauguration to have another go at stimulus and then conversation of infrastructure spending. So I think things are basically going to be on hold until the handover of power on January 20th. Well, the market is repositioning not only because it's going from a Republican presidency to a Democratic presidency, but it's still undecided whether the Senate remains in Republican control or is handed over to the Democrats. So we might end up with a split Congress. We might end up with a unified Congress, unified government, because all three branches, the executive and both houses of the legislative branch, are in Democratic control. So there is still a lot that has to be resolved yet. Well, both scenarios, a blue wave or a split Congress with a Democratic president, have resulted in average annual price increases that are better than the average for all years since World War II. Meaning if the 22 times that we have had a trifecta, a blue wave, the market gained 9.8% in that calendar year, yet in those as compared with 9% for all years. Whenever, however, we had a split Congress that was headed up by a Democratic president, and that only happened under President Obama, the market gained 13.7% on average, which was very strong, but we only had 4 observations, so it's really not statistically significant. So history would say either scenario was going to work just fine for the markets. Well, I think if you are a long-term investor, yes, you don't really worry too much about trying to time your entry points. While I do think that we are overdue for some sort of digestion of gains, in particular in the small cap stocks, the Russell 2000 is currently 34% above its 200-day moving average, and that is the highest differential on record over the past 40 plus years. So I think that we probably do have to at least play catch up and pause on the small cap arena in order for the averages to catch up to the price itself. But I think a year from now, we will still be looking at a 10+% price appreciation. So because Tesla does have a higher standard deviation and beta relative to the market itself, then yes, because it is being included into the market at such a high percentage, that it will likely push higher the volatility for the overall market. Certainly for the consumer discretionary sector, because it is going into the automobile group within the consumer discretionary sector, which causes that sector to grow by more than 13%. And so as a result, it'll play a much bigger impact on consumer discretionary than it will on the market itself. P500 is meant to be a reflection of the economy within the U.S. as well as a representative of the total large cap stock universe. So S&P does not look to a company to say, is it speculative? Is it a good fundamental buy or whatever? No, the purpose is to have it be reflective of the overall U.S. stock market. It does have to pass several tests, such as being profitable, not having more than 50% of the shares owned by insiders, etc. But it does not make a value decision as to whether you should buy whole or sell the shares.